Hello and good morning, everybody. My name is Ryan Hughes and I'm Head of Active Portfolios here at AJ Bell, and I am delighted to be bringing you the Q4 2020 update to the AJ Bell Managed Portfolio Service. It's amazing that another quarter has gone by. There is lots to get through today, so I'm going to crack straight on this. Let's have a look at what's on our agenda on today's update. So I'll give you a quick introduction to AJ Bell Investments. Lots and lots of new users of the AJ Bell MPS over the last quarter. So conscious that quite a few of you are tuning in for the first time. Thank you for your support. It is most welcome. I'll review our MPS performance. I'll also look at markets over the fourth quarter. Quite a bit has happened in that quarter, as we all know. I'll look back at that and also to look at the main issues that have been driving the different MPS that we have, talk through some of the changes, and also try and give a little bit of a market outlook. Although, as we all know, with what's going on in the world right now, that is particularly difficult, but we'll give it a go nonetheless. So, just a quick introduction to AJ Bell Investments for those of you that aren't too familiar with what we do. We were launched in 2016, so we're building up a really nice track record now. We've been doing that, I'd say reasonably quietly, just getting on with running investments for advisors. And actually, I'm delighted to say that during the last quarter, we went through over 1 billion of assets under management, which is fantastic. So thank you to everybody that has supported us on that journey. It's a real milestone for us to reach the £1 billion figure, and of course we look onwards and upwards, and now start thinking about how we grow the business even further. But I think to get to that point shows we've really got critical mass and have grown nicely and have built a credible asset management business within the wider AJ Bell business. A very wide range of solutions that we continue to have. So passive and active MPS, both on a growth and income basis, the Pactive, which is the marriage of active and passive MPS, as well as passive funds, income funds, and the retirement portfolio solution. But also something that I'm not going to go through today in this update is also our recently launched responsible fund. Slightly different approach to our passive funds and MPS, and therefore we'll look to cover that separately, but rather than going through it in this session. So what about our performance? Well, where are we? Well, the passive MPS has had a really strong final quarter of the year. You can see there that performance ranging from around 3% to the lowest risk portfolio, right up to 11.5% for the highest risk portfolio. And then when we look at the 12-month basis, so in the middle there, 2020, well, I think if you listen to my update at the end of March, at the end of Q1, I think it felt like getting a positive return for the year was a long way away, and actually we delivered returns of just under 4% up until just over 9% for the passive MPS. So a pretty strong set of numbers, and of course these the passive MPS have got a much longer track record. They've got beyond 3 years there as well. So take a look on the fact sheets at your leisure, and you'll see some quartile rankings, and that's a set of numbers that we're really proud of. If we look to the active side of things, well, actually a very similar picture. Again, a strong quarter. What we saw over the quarter, and indeed actually over the year, was that at the higher risk end of the portfolios at Active 5 and Active 6, they really captured some strong performance this year, particularly helped by some exposure to smaller companies and Asian smaller companies in particular. There. So again, some strong performance. The 3-year track record hasn't quite been hit. That will actually be hit in February. But again, the fact sheets will show you the quartile rankings, and those long-term numbers are ones that we continue to be very proud of. A brief mention of Pactive. Lots and lots of you using the Pactive portfolios, wanting to have some exposure to active managers, but equally wanting to keep those costs low and have some exposure to the broad beta of the market. So these portfolios, again, also don't have a 3-year track record yet, but a strong 3 months, a strong 12 months there. And I would say performing in line with expectation. Lots and lots of numbers on those last few slides. I would urge you really to look at those at your leisure, and perhaps take a deeper dive on the fact sheets where you can get some quartile performance too. But of course, remembering we don't manage to beat those sectors, it's there as a reference for reference purposes only. So that's to look back at our performance, but what about markets? Let's look at those. So we've got global markets here for the fourth quarter, and quite an interesting set of data, and clearly really strong. You can see the day there in early November, when the vaccine news was announced, that you saw markets climb higher very sharply there. And this time around, we've seen emerging markets, we've seen Asia lead the way over the quarter. Actually, it was the very last day of the year that changed this picture, because right up until New Year's Eve, the FTSE All-Share was leading the way for the quarter, and you can see right at the right-hand side of that chart that a big fall in the market on the very last day of the year just dragged the FTSE All-Share back from being the leading market over the quarter. But of course, it started 2021 very strongly already, with some big moves up there. S&P 500, perhaps unsurprisingly, a laggard over the quarter. I mean, it's led the way for so many quarters. You look back over these quarterly updates time after time, I'm telling you the US has been the main place to be, but it lagged away this time, and other markets played catch up. Really, and we've seen that, and I think that's, the bond market. We've also seen some strong performance over the quarter. High yield on the coattails of the equity market doing very well. Corporate bonds doing well, again helped by the vaccine, helped by a Brexit trade deal, all of those positive things that we'll talk more about in a second. Whereas government bonds, well, UK were just about flat. And in the US lost a little bit of ground. I should say, as ever, all of these numbers are in sterling, and so are held back by the performance of sterling over the quarter, as we'll look at in a little bit more detail. I thought it useful, being this is the last quarter of the year, to also look back at the full year picture there. Now, in some respects, it's not dissimilar actually to the quarter. So Asia and emerging markets actually beating the US over the full year, and that might surprise a few people. Of course, if we put the NASDAQ on here, then that would trump everything. I realise I've just used the word Trump, which feels quite inappropriate at the moment, given what just happened a couple of days ago before I recorded this on Capitol Hill. But Asia and emerging markets performing very strongly, and in fact, global equities on the whole up 12% for the year. And if we think during March that we were off around 20%, then that marks a huge recovery. Now, we talked about UK having a good quarter and the final quarter, but clearly you can see on this chart it has lagged global markets by a significant amount during 2020. I mean, a loss of nearly 10% over the year when Asia is up 18%. It just shows how out of favour the UK has been. It's had that millstone of a Brexit problem hanging over it right until Christmas Eve, and maybe, just maybe, this will be the time now that we start seeing UK equities becoming a little bit more appealing for both domestic and overseas investors. Now, some of those clouds have parted. So let's look at some of those major issues in a little bit more detail. Well, clearly the vaccine is the big news. Not one, not two, but three vaccine announcements in November for the Western world. China has got its own vaccine going, as has Russia there. So yeah, that clearly was the boost to markets that maybe investors could see a way forward for society, and start thinking about 2021 as a return to some kind of normality there. Obviously, we had a Brexit deal as well, Christmas Eve, as I mentioned, providing some clarity for UK investors, and our trading arrangement with Europe, and many trade deals signed as well over the last few months with other countries around the world. I think we're at 62 currently, and that number seems to be increasing pretty much every day. And of course, a new US president. I mean, just one of these events would be momentous enough in a quarter, but to get three just shows how much news there was. Trump losing the election to Biden. Many things have happened since that day in November. Obviously, legal ramifications, a march on Capitol Hill just a couple of days ago, and those really shocking and terrible scenes there. Hopefully now we'll see an orderly transition of power there. But actually, in the grand scheme of things, for the US, for markets, it didn't make a huge amount of difference. It's quite surprising to see just how stable US markets, both equity and bond markets, have been with that news there. But high yield bonds, as we look away from those main factors there, high yield bonds, corporates, all very, very positive as central banks continue to have their major stimulus, their buying of bonds in the market, and that is clearly providing a huge underpinning support to the market and looks to continue for some time to come. So looking at a couple of those factors in more detail, often we show the gilt yield chart here, as I think it's very interesting to look at as a representation of sentiment. Now, if we look on the right-hand side of the chart and see that period between October and December, I mean, pretty much you can track the news as to whether markets thought there would be a deal or there wouldn't be a deal. And you can see the gilt yield going from 20 basis points to 40 basis points, back to 20 basis points, up to 30, down to 20, up to 30, down to 20, as every piece of news came out as there was a deal or there was no deal, etc., etc. Now, actually, interesting, we might have expected the bond yield to widen out significantly on news of a deal, and actually it stayed pretty tight. It's only post year end that actually that's really started to move out, and that might be as much to do with the volumes and trading as anything else. But very, very volatile in the bond market, particularly the government bond market, and we could have put a chart of sterling versus dollar. Would have shown you a very similar picture as those markets were hugely volatile in the run up to Christmas Eve. Excuse me. Now, long-term chart here of US GDP. I think what's interesting to look at is, you know, we talk about the huge scale of the COVID crisis, and of course it's massive, and the toll on society and on people across the world cannot be underestimated at all. And we can see the hit to US GDP here, but also we can start seeing the recovery here as well. And I think it puts it in an interesting long-term context as to what that hit is. Clearly very painful, clearly will take some time to recover, but it's already recovering. I think when we think in a global context, I did read a piece of research over Christmas which suggested that China is now expected to overtake the US as the largest economy in the world 6 years sooner than this time last year, because of the impact of the coronavirus COVID crisis. China obviously recovered quickly, has got back to relative normality, whereas countries like the US and Europe and UK are clearly continuing to struggle with lockdowns and restrictions. And so that 6-year number is a huge change that represents the massive growth that we are seeing in China. And despite the US recovering quickly, clearly the march of China to becoming once again the world's largest economy is continuing unabated. Worth looking at China, actually, just briefly. China, and you saw in the previous slides, Asia and emerging markets driving very much higher. You can see this is a chart of Alibaba. So clearly one of the largest stocks that there is. It's the largest stock in Asia and one of the largest stocks in the world here. But really interesting as we got to the end of the year. So Ant Financial, which is effectively the payment engine of Alibaba, was planning to have the largest stock market listing in history. And what you can see right on the right-hand side of that chart is a huge straight line down there. And it just so happens that a couple of days before the IPO, that Jack Ma, the head of Alibaba, made some comments that the Chinese government didn't find too acceptable, and they immediately cancelled the IPO with just a couple of days to go. There, they've subsequently done a big audit of Ant and have ordered some changes there, and Jack Ma effectively has not been really seen on public markets since that point. So Alibaba over the full quarter was actually down about 30% there. So it just shows perhaps how well many of the other companies in Asia and emerging markets did to drive that quarterly performance when the largest holding there was down 30%. But I think perhaps, why am I showing you this chart? I think it's a really interesting signal that the Chinese government are taking financial stability very, very seriously and are looking to improve governance standards around even the biggest businesses like Alibaba. So I think maybe this story's got more to run. Maybe there'll be further tightening and controls around other parts of the Chinese financial system. And lots of fund managers talk to us about the risk of Chinese levels of debt. And I think that's not lost on Chinese government. And so their tightening of restrictions on Ant and Alibaba may be a sign of things to come. And actually, I think many people would welcome that to ensure that it becomes a properly regulated, robust financial market, which of course would mean it could play a much larger part in the MSCI global indices, which are still restricted in their weight while the improvements to the Chinese system are made. So that's a little look back at some of the major things that have been driving markets. What about the performance of the MPS? Well, we're talking kind of generic terms around the passive and active portfolios here, and then we'll look at some of the specifics of the active. Obviously, the major events that I've talked about around the world are the drivers of the passive performance, given they track the markets. Pleasing to see strong returns across all portfolios over the quarter. Particularly on the income side of things, which has had a recovery after a really tough time. We'll talk about that a little bit more in a second. But a very wide dispersion in asset class performance, as we've seen. Risk assets absolutely benefiting from the positive sentiment in the vaccine. Now, where did we see that most strongly? Well, in the value, we've talked lots and lots over many quarters now about value and growth and the dispersion between value and growth and how value has been an underperforming strategy for a long period of time. Well, Q4 saw a reversal of that with the vaccine news. So value stocks performed very, very strongly in the fourth quarter, and actually it was those quality growth stocks that were held back, that have been winners for a very long period of time. So we saw strong performance from things like the banks, dare we say even the airlines, some of the travel companies, some of the house builders. These types of businesses really, really bounced off their lows and had very strong performance in the fourth quarter as investors look further forward into 2021-22 to a return to normality. It's quite hard to talk about normality when we're sat here under lockdown number 3, thinking about our summer holidays and will they happen, thinking about going back to eating in restaurants again. But the market is forward-looking, is not looking at the next couple of months, is looking at the next 12 months, looking at the next 3 years and thinking about what will happen then. And that's why value stocks perform very, very well. Talks about UK equities having a better quarter. They are the UK is a market which has a much higher value tilt to it than other global markets. So Asia is dominated by the Chinese internet stocks and Samsung. The US is dominated by the US technology stocks. In the UK, of course, our index is dominated by banks, it's dominated by oils, some large cap pharma, and those, with the exception of pharma, those kind of stocks have not really been the place to be until the fourth quarter. Sterling was pretty strong, as we mentioned earlier on, and that did hold back overseas earnings, and also US treasuries were weaker on an unhedged basis. So we hold some of these US treasuries in dollars as a hedge, as a position, a risk off position. So when things look ugly, these holdings do very, very well, but we hold them in dollars, and therefore as sterling rallies, then their returns are weaker. But all in all, when we look longer than the quarter, they've been a real help to performance this year. So what about within the active MPS growth? And by active, of course, I mean within the active and the Pactive as well. Well, value we just mentioned on the previous slide. We saw that come through from man undervalued assets, from Dodge and Cox US stock, and other value holdings. Significant outperformance of mainstream markets over the fourth quarter. Now, of course, they're coming off underperformance into that period, but a recovery has certainly been seen. We will see whether this value rally continues and how long it continues for. Obviously, we've been in a very long period of growth outperforming, and maybe, just maybe, value is it's time we're seeing a market rotation we run the portfolios on a style diversified basis, and so we will always have some exposure to value to ensure that we're not taking huge bets one way or the other. And so pleasing to see that these captured the rally. Also, a notable mention for Artemis Corporate Bond. It was added at the end of the last quarter in late September, and has had a really good quarter, helped by exposure to the bonds of things like financials, of airports, which had looked oversold previously and bounced back. And I mentioned about Asia. Very strong performance from our Asian managers: Schroeder Asian Alpha Plus, JPM Emerging Markets. Consistent theme across Asia was exposure to Samsung. Now, Samsung was actually up 50% over the quarter. So while we saw Alibaba up 30%, Samsung was up 50%. So a really strong quarter from Samsung there, and the active managers managed to capture that, which was good to see. Well, on the detractors side, well, as I mentioned about quality as a style underperforming, this of course means that Trojan Income would underperform broader markets, perfectly in line with expectations, which is why we offset that with Man undervalued assets. So the value manager did very well. The quality manager was relatively flat. Those two managers blend well together. Interestingly, also we saw healthcare lag broader markets, and healthcare is really in the eye of the storm from a perspective of the US presidential election. Investors worried about what Democrats might do, and that held back healthcare stocks over the quarter. Now, as the election result came through, it was interesting to see healthcare actually perform reasonably well, because Biden at that point had won the presidential race, but the Republicans still had control of the Senate. And when you've got that situation, the president actually got relatively limited powers. However, obviously what we've seen in the last couple of days, post-quarter end, is that the runoff race for 2 Senate seats in Georgia has actually been taken by the Democrats. And so now we've got the situation where Biden has control of the presidency, the Democrats have control of the Senate, and Biden now has a much stronger ability to put through his reform agenda. So we watch with interest as to what this means for healthcare stocks in the coming weeks. I talked about US Treasuries and the strength of GDP and holding those back. They're held in passive ETFs, very low cost there, and they were a detractor over the quarter as that risk mitigator, as I mentioned. So what about income? Income, as we all know, has really been a very tough place to be during the quarter. It has, not during the quarter, during the year, with dividend cuts across the board from companies, particularly in the UK, dividend cancellations, dividend postponements, you name it, we've seen it, and that held back return of any stock paying an income. Well, definitely signs of improvement in Q4, a clearer path back towards dividends for many companies, companies reinstating their dividends, which is great to see, companies hinting that next year they might well be paying much greater dividends to kind of pay out some of the money that they made this year as they've paid back their government loans. So a much improved picture, I would say. Now, clearly the UK has rebased its dividend lower. UK was a very high yielding market pre-crisis, and many companies have rebased their dividend lower, and therefore the UK now offers a much smaller premium over global markets from a yield perspective, but that premium is still there. Fixed interest was solid growth over the quarter from an income perspective. Corporate bonds, definitely very positive. Obviously, yield compression has been seen in corporate bonds, and lots of talk about negative rates possibly coming in the UK. So this will be a challenging area to deliver income from going forwards. But as we say, a much improved picture from an equity perspective. Property equities were much higher on the back of vaccine news, again with a clearer path, but structural challenges, particularly in the UK, remain. Structural challenges to the high street. I think it feels like that's an embedded permanent change that we've moved to an online shopping model, and that's more difficult to get us all back to the high street. Now we've felt the full benefit of convenience of doing it from our home, and even office property as well. is this a major permanent shift towards working from home where companies will need less office space? So they've bounced back, but we're looking quite hard now at what the opportunity is going forwards for that, and it may be an opportunity, it may be to exit those property equities over the coming couple of months. Infrastructure was also strong as well. Lots of governments talking about infrastructure spend to boost their economies, and infrastructure stocks did well on the back of that. So what about recent activity? Well, relatively little activity over the quarter. Just one change was made in the active and Pactive growth models, and that is in Japan. So the Man GLG Japan Core Alpha Fund, which is a deep value manager, and has actually been struggling a lot with deep value being out of favour. Well, two key managers in that team announced their retirement, and we felt that they were core to the investment process, and that there was just too much experience walking out the door at one time, and therefore we took the decision to remove Man GLG Japan Core Alpha from the portfolio and replace it with the Jupiter Japan Income Fund. Now this is perhaps a little bit more core in its approach. It's a solid, experienced team managed by Dan Carter, and looking for those stocks that have got dividend growth potential. And as we know, Japanese companies are sat on huge amounts of cash, really massive amounts of cash on the balance sheet, which they are slowly returning to shareholders in the form of increased dividend payouts. And so we think this is a really interesting strategy to have exposure to as companies can grow their dividends from here from a position of strength. Within the passive growth portfolios, no changes were made over the quarter at all, and that was actually the same picture in the income portfolios, where we didn't make any changes over the quarter. So relatively stable. As you all know, we are long-term, low turnover managers, and therefore we do have low turnover during the year. But of course, what we do is do our updated annual strategic asset allocation once a year, which will be implemented in February. So we're working through that at the moment and thinking about what the right shape of the portfolio is going forwards. So let's just try and bring this together as a little bit of a market outlook. Well, it's really encouraging to see that investors are pricing equity markets beyond the COVID crisis now. As we've talked about a couple of times in the last 20 or so minutes, equity investors are looking ahead. We're seeing markets at record highs in the US, in Japan. There's a 30-year high going right back to the late 80s, and post the bursting of the Japanese equity bubble, it's recovered to those kind of similar to those kind of levels. But definitely a major split between Western and Eastern economies. As we all know, we are right in the midst of a second wave hitting particularly the UK and Ireland hard right now, looking like that might be spreading into Europe. And so that's a real challenge for Western economies, whilst Asia continues to grow. And we've talked about the long-term impact of that that's happening over the coming years. Government central bank support will be needed for much longer. Excuse me. Suppressing rates much further. Negative rates are a possibility in the UK, of course, and we've already seen them in Japan and Europe, and what that does to the bond market. So rates low for a long period of time. Brexit clarity and the new US president, fantastic. Remove two major disruptive risks from the market, and you're already seeing the benefit of that in the UK, particularly over the last few days. So that's a theme I think that's likely to persist during 2021. As I mentioned, the annual update work is being undertaken right now. We're working through that with a view to updating in mid-February, and therefore we will come back with information on what those changes are. Obviously, lots has happened in the last 12 months, which is making us think really hard about what's the right shape of the portfolio. Looking forwards, obviously strong growth in things like technology, very weak performance in things like oils, and so looking at all those types of areas for making sure we've got the most efficient portfolio possible across the board. But we'll come back on that and do an update on all of those changes and talk you through them at the appropriate time. So that's all I wanted to go through today. These are always relatively quick updates, around 20 minutes, half an hour. talking through what's been going on in the markets and in the portfolios. As ever, we thank you for your support. There's more detail contained in the quarterly reports on our website. The fact sheets will there. You'll be able to see all of our quarterly performance as well, and all the usual transparency around what is happening in our portfolios. One final thing to mention, which we've literally just been able to tell you, which is fantastic news, which is we have been able to remove the VAT element from the MPS fees on these portfolios, and that means we take our costs down back to the annual management charge of just 15 basis points for the MPS service, making it one of the lowest cost MPSs in the market. So we're really pleased that we've been able to take away the VAT from the portfolios. That is actually backdated to October because we haven't run the fee run yet for that. So backdated to October, no requirement to provide any refunds there. So I hope that's good news. Further communications going out. Hopefully by the time you listen to this webinar, you will have received those communications. And if you want any more information on what we're up to in the portfolios or any aspect of our service, then please do talk to your usual AJ Bell contact, and we'll be delighted to hear from you. So that's all I have to say. Thank you very much for listening, and if you have any queries, do get in touch, and we look forward to speaking to you again soon.